Today we'll be talking about the recent outflow of deposits from U.S. banks. According to new Federal Reserve data, depositors withdrew another $126 billion from U.S. banks during the week ending March 22nd. The outflow came from the nation's largest institutions, with the biggest 25 banks losing $90 billion. The smaller banks, however, were able to stabilize their outflows and even gained back $6 billion. Total industry deposits fell to $17.3 trillion, down 4.4% from the same week a year ago. This is the lowest level since July 2021. So why are deposits falling? Well, many observers attribute this industry-wide shift to pressure being applied by an aggressive Federal Reserve campaign to lower inflation. During the early part of the pandemic, when interest rates were historically low, banks were awash in deposits. But when the Fed began moving those rates higher to cool the economy, customers who had deposits began seeking out places with higher yields. Some of this money is flowing to money market funds, which offer higher yields than traditional savings accounts. Since the beginning of January, investors have poured $508 billion into those funds. Narrator: government and industry officials have been working to prevent massive deposit outflows in the aftermath of March's bank failures. Regulators pledged to cover all depositors at both banks they seized, hoping that would calm any panic, and also promised to help other regional banks if needed. The challenge the deposit outflows create for all banks is that if they raise rates on their deposits to keep customers, that could make them less profitable. But if they lose too many customers, as Silicon Valley Bank did, they give up critical funding and may have to sell assets at a loss to cover withdrawals. Silicon Valley Bank customers withdrew $42 billion in one day, leaving the bank with a negative cash balance of $958 million. That forced regulators to seize the bank, which was the 16th largest in the U.S. So, what are the key takeaways? Deposits have been declining at all banks due to pressure from an aggressive Federal Reserve campaign to lower inflation. Some customers are moving their money to money market funds with higher yields, and the recent bank failures have created challenges for all banks in terms of maintaining profitability and critical funding. Thanks for watching, guys. I hope you found this video informative. Don't forget to hit that like button and subscribe for more educational content. See you next time.